So over the last 2.5 decades, like I said, on balance, equity has been taken out of the market. But now we're about to have a massive, massive amount of supply. An additional 400 billion coming to the market.
That's real money.
It is a lot of money.
Yeah.
So I think the it's going to be a bumpy road from here to the end of the year.
Hi, today we're going to discuss the oil price and the peace deal, and secondly, inflation and the central bank outlook. Welcome to another Super Macro podcast. My name is Elvis. I'm joined by Jonny Matthews, veteran hedge fund manager. Hi, Jonny.
Hi, Elvis. How are you?
Okay, not too bad. I've got a question for you. Oil prices back down to where it was before the war. What's the deal? Why is everybody panicking? That's it. We're done.
That's it.
That's
it. It's all sorted. Problem's over.
Trump's not causing any problems and we're fine.
Yeah. You've got to bear in mind, something like 14 million barrels of oil per day were traversing through the Strait of Hormuz. Now, some of that was diverted during this conflict through the pipelines in the Emirates, and a lot of it has been basically lost to the market. So there's a deficit of about, well, let's face it, the conflict's been going on for over 100 days. So it's about almost a billion barrels of oil.
So it's got to be made up at some stage.
At some point it has. I mean, if you look at chart 1, if we could get that up on the screen, and there's 2 lines that are all over the place. The red line is actually global inventories, global crude oil and liquid fuel inventory. And, you can see during the pandemic it went through the roof, and then it was drawn down once the economy reopened. And then Russia invaded Ukraine and the oil price went through the roof and inventories got drawn down a lot further.
So inventories, basically they draw down inventories to cap the oil price, because that's one stage threatened to go to parabolic numbers. Yes.
But we were able to do without the Russian oil. And as you can see, the oil price normalized pretty soon after that, and inventories were rebuilt. But more recently, especially in the States, inventories have really got down to close to critical levels.
So Trump's peace deal has come at the correct time.
Yeah,
Isn't that a surprise?
I think it was getting to the point where something had to be done. Otherwise, the oil price would have gone, potentially through 150 or 200 to $200
and not to
a
mention
barrel.
midterms coming up and the fact the Americans don't like
There
the
is
war
that
anyway.
as well.
Yeah, so
There are a few reasons.
Yeah, okay.
But I don't think that I don't think oil is going back down to where it was, $50 or $60 a barrel anytime soon.
So you see this being that they will take the opportunity now to rebuild those stocks for obvious reasons in case another shit show starts again.
Absolutely. I mean, it'll take time for the supply to come fully back online, and the demand will be there. The additional demand will be there from the rebuilding the stockpiles.
Okay, let's move on. By the way, Federal Reserve.
Yeah.
Good call on the hawkish pivot. You told us that the SEPs were going to be a lot higher, the inflation are going to be a lot higher, the projections, etc. I think we've got a clip from last week's show when you said that.
Okay. So all in all, I think the bottom line is the dot plot is going to skew a lot more hawkish out of this meeting.
By the way,
yes.
Most importantly, that's what everybody likes to do when they trade.
I know where this is going.
Did you make any cash?
Only a small amount. In fact, yeah. To be honest with you, it was difficult. Prior to the meeting, I looked at this and I was pretty convinced the dot plot was going to look a lot more hawkish, and the Kevin Warsh isn't the outright dove that some people expected him to be. So I was expecting this Fed meeting to be perceived as hawkish. But, I thought about selling SOFR futures. I thought about selling futures on the 2-year note. And I kind of talked myself out of it. I thought, well, surely, most of it must be priced by the market by now.
The herd's correct in this particular thing. Yeah.
I was short of, longer dated bond futures, 10 futures on the 10-year note and options on the long bond.
Right.
So Made a small amount of money.
Disappointingly, didn't make enough from a good call, which was against market trend.
Yeah. But things are a bit better today. And I think the reaction out of the meeting was kind of strange because the yield on the 2-year note spiked something like 13 basis points on the day. And over the whole of last week, the 2-year yield was up about 10 basis points, I believe. The 10-year yield dropped 3 basis points.
Big flattening.
Yeah, quite a dramatic curve flattening. The consensus steepening trade took another hit.
Yeah, someone got felted. Yeah. No
so now we're down to something like 27 or 28 basis points between the 2-year and the 10-year yield, which is, it was out to about 60 basis points a little while ago. And what is happening is the market is coming to the conclusion that the Fed is going to be more hawkish than was previously expected and get a grip on inflation.
That's what he said, isn't it? We've missed for 5 years. Warsh said we've missed for 5 years and we're going to fix that.
Yeah, and it seems like the market's taking him at his word. Yeah. I'm not so sure. I'm not so sure it's going to be that easy. They missed for 5 years, as he rightly said, and it wouldn't surprise me if they missed the target for another 5 years. I don't think we're going back into that environment of low and stable inflation that we had before the pandemic.
I think you've been consistent on that message for quite some time.
And I think if you look at chart 2, we've had the May CPI and PPI prints already.
So you can predict the PCE.
We know what the PCE inflation will be, and I've included that on this chart. Core PCE inflation is probably going to tick up from 3.3% to 3.4%. We get the release later this week. I'm not sure about core PCE services inflation, but ordinary core inflation is going to tick higher. And if you look at this chart, it reached a low in April of 2025, and it's been heading higher ever since.
Yeah, you've made the point before that what was a ceiling is now becoming the base.
Yeah, it's kind of a floor.
Like 3% or something. Was a ceiling, and now it's the base.
Yeah, if you look prior to the pandemic, core inflation never really got much above 2%, and core services inflation never really above 2.5%. Well, they haven't got down to those levels since. And now they're heading up. So, I think that those core inflation dynamics mean that you're just not going to get headline back down to 2% anytime soon. I really don't see it.
Do you know, Jonny, I'd like to play some devils with you on this one. I don't see pay growth ripping away like it has been. In fact, it's slowing up. That should slow up service inflation. I still believe that Warsh owes Trump something. And Trump, we know what he wants. All he wants is one thing, is lower rates. Do you see that maybe Warsh's first meeting had to be this way to convince markets he was going to get inflation under control, and then he can use maybe the lower oil price, inflation lowering down next month again, and pay growth not so aggressive as a way to turn dovish?
Well, you made a number of points there. I want to first say that I mean, from my experience of Kevin Warsh from years ago, he was a massive hawk during the financial crisis. Throughout that period, always hawkish on the balance sheet, hawkish on rates, even when the economy was on its backside. Sure, about a year ago, he made some very dovish comments talking about how productivity should improve with AI and so on. But you've got to bear in mind, he should have, he's got a 4-year term. He may get a second 4-year term.
That'll be post-Trump, won't it?
Oh, absolutely.
Yeah.
I don't think, realistically, he's interested in just appeasing Trump. I think he's more interested in leaving a legacy.
But how did he get the job in the first? I'm sure that Trump...
Well, I think his father-in-law is very friendly, one of Trump's best friends. That helps. But
okay, fair enough.
Make no mistake about it, he is fully qualified for this job with his background. Morgan Stanley, a previous appointment as a Federal Reserve I can't remember if he was a governor or a regional Fed president, but either way, he's got the experience and the qualifications.
Right.
So, and just to come on to your second point about pay growth, you're right, it has slowed. But I can see, you've got to bear in mind, we've had 500,000 jobs created over the last 3 months. Non-farm payrolls have gone up by 500,000 in the last 3 months. So labour demand has picked up. There was a soft patch about a year ago in the summer of last year. Things have improved. And I've spoken about the high frequency data on numerous occasions.
Oh, so the pay growth lags employment growth.
I do think so. And if we look on chart 3, if we can bring that up, I'm showing here the ratio of job openings to unemployed. So this is the JOLTS data, the job openings versus the unemployment from the household survey. And it started moving higher.
You think that leads the hourly earnings? Well, I assume it must do.
Yeah, I do think so. I mean, the relationship's not super tight, and you've got to bear in mind the JOLTS data themselves are not, they're frequently revised, and especially the most recent print that we had.
Backward looking to start with.
Yeah, it's backward looking to start with, and the recent print, there was a big surge in leisure and hospitality job openings. An unusual surge, let's put it that way. So, it may not be 100% accurate, but if you look at that ratio, has started to trend higher. We know that job demand has improved dramatically from last summer. We know that payroll growth has increased, and I can see, a few more months like this, and I think Labour will get some more bargaining power.
So the US economy is still okay. If according to you, it's always been fine, and you've never been, the 350 million recessions predicted on Twitter haven't come through.
Yeah.
And
I've been quite consistent about that. But I mean, so for as far as I'm concerned, we could be at the start of a shallow tightening cycle. I don't know how far it's going to go. But I never believed that the Fed had much further to go with easing, because this is just a higher growth economy. It is a more dynamic economy. And I don't think that it's a higher growth, higher inflation economy. And I think the appropriate rate is higher than many people expected previously.
Can we just have a quick chat about the reforms that Warsh has announced he's going to be looking at? 5 task forces. I'm going to read them out. Communications, the balance sheet, data sources and methodology, which is, I think, the one you probably want to talk about. Productivity and employment and inflation. You and I have discussed this numerous times, and we've talked about this, and you've made a point numerous times. They can't just change the way they look at inflation, for instance, a particular inflation metric that suits their narrative, because the market won't buy it.
No, absolutely. I think actually, this task force, the purpose of the task force looking at data sources and methodology. I don't think he's thinking of changing the inflation target to a different type of
maybe the metric, not the target. Maybe the metric they change.
I think they may start looking at trimmed mean measures paying a bit more attention to them, but the target can't be changed. I think the Fed would really lose credibility if they tried to change the actual basis of the target. And so, but I think the more important points on this are the balance sheet.
Yes.
Trying to reduce the Fed's balance sheet.
Smaller footprint, that's what we are, isn't it? Is that what you would, part of that?
It's part of it, but I don't think it's that straightforward. Warsh was very critical of the successive rounds of QE during the financial crisis. But I think now we've progressed from there. It's not so easy to reduce the balance sheet. Let's put it this way. The banking regulations have changed dramatically from that period. Banks are much more highly regulated now, and they have to hold a much greater share of liquid assets on their balance sheet. There is the liquidity coverage ratio. They have to have more high quality liquid assets as a share of total assets. And to put it simply, they have to hold a lot more reserves.
Right. So you can't drain those reserves and put them into treasuries. It's not as simple as that.
Well, look, it's down to the Fed how many reserves are in the system. But if they drop below a certain level, and we saw that in 2019, there was a massive squeeze in overnight rates. I think the overnight the repo rate went as much as, I think it hit 10% intraday, which is crazy. So they want to avoid another squeeze on repo rates. And in order to do that, there have to be adequate reserves in the system. And so unless there's a change to banking regulations, I don't think it's possible. Now, there could be a change to there is a powerful banks lobby that would like changes. But I know that Michael Barr, he's a Fed.
The Lehman, pre-Lehman, and that action that the banks were having in the noughties was, or not noughties, in double O's rather, leverage up to the hilt, etc. They don't want to go back to that.
Certainly not. And Michael Barr, he's the vice chair for supervision. He is dead set against any easing of banking regulations. So I don't think it's going to be hard. They'll go through
reducing
the
the
task
balance sheet
force.
can be very hard. It might happen very on a gentle slope, but it's nothing going to be. You probably might not even notice it.
Yeah, I mean they can take it down slowly, but I just don't think they can allow the amount of reserves in the system to fall below a certain level. Let's face it, the balance sheet has already come down from something like 8.7 trillion, I think, to 6.8 trillion, I think.
Right, is it below 7 now?
Yeah, between 2023 and 2025.
Are they reinvesting?
Yeah.
They're still reinvesting.
That's like they have to. Otherwise, the coupon payments and the redemptions every month, some bonds will be redeemed. Right. Otherwise, there'd be quite a sharp balance sheet runoff. So they'll continue reinvesting for sure.
Something that took my eye from the Fed meetings, what he said here. He said, I'm going to read it out. The effect of current monetary policy is uneven across the economy. Interest rates are restrictive for the housing market, but clearly not restrictive for the stock market. Now, how does one solve that little riddle?
I don't think you can, really. And I don't think it needs to, really. I mean, I don't think the Fed should really be trying to stimulate the housing market. They made that mistake previously. But let's put it this way. The average rate on the total stock of outstanding mortgages, 30-year mortgages, has been creeping higher. It was lower than 4% about a year ago. It's now, I think it's something like 4.3% or something. It's creeping up and up and up as mortgages get redeemed, as new people enter the market, take out a mortgage with a 6.5% rate.
Right. Well, that was always going to happen after the super low rates post the GFC. Yeah,
it just, we ended up with a situation where a large proportion of homeowners had very low mortgage rates locked in, and when in the US, when you move house, you give up that mortgage. And people just didn't want to give up a mortgage
with a late 2 early 3 handle.
Yeah, exactly. And rightly so, because current mortgage rates are 6.5%. But the average across all the outstanding mortgages is creeping up at about 75 basis points per year. So we're at 4.3%. Another couple of years, that average will be in the high fives.
Yeah, over 5, yeah. Okay.
And so then the spread to if mortgage rates are still 6.5%, it's not such a big deal.
No, I agree. I get that. Should we switch over to equities? Or do you want any more you want to add on the Fed?
No, we can talk about equities because I think, as far as the equity market is concerned, it seems kind of unconcerned about what the Fed does.
Unconcerned about anything.
Yep, very true. But I am just concerned that as the Fed begins its tightening cycle, however long the cycle may take, we could see
The
bit more
road
volatility.
could get more bumpy, maybe.
Yeah, I think so. I mean, if you look at chart 4. Chart 4, the red line is the Fed funds, the mid rate, and the blue line is the S&P 500. And when the tightening cycle began in 2022, the S&P ended the year down 20%. Of course, the tightening cycle continued and the S&P righted itself. Growth was extremely strong. Earnings were shooting higher. And the market continues to go up and up and up. But in the last year or so, the market has been used to, up until March, forward rates coming lower. That's changed. And now we may be approaching a point when the Fed does actually start tightening policy.
Yeah. Okay.
And so there are reasons to be a little bit more cautious of the equity market now.
We've got, I think, the end of this quarter, according to what I read, 165 billion of as it rebalancing is due. I know that you've explained to me that it doesn't happen over a few hours; it happens over a period of time, but it's still a chunk of change.
Yes. What you're talking about is, for the balanced portfolios, they like to keep
the 60-40s. Yeah,
the 60 or whatever proportion they have, 60% in equities and 40% in bonds, and equities have gone up a long way and bonds have gone down. So it's rebalance, which means 165 billion of supply coming to the market. That is, potentially absorbable. It won't come instantly, as you say. It'll come over several days, but we also have the additional supply.
I can see you've got another chart up in front of you, which brings me on to my last point. Had the SpaceX IPO.
Yeah.
What did that raise? 85? Was it 85? I can't remember the number.
75 or 80?
75, 80. Well, let's call it 80 billion. All right.
Call it 80 billion.
Right.
Okay.
Got 85 billion coming from Alphabet. Then further raises from OpenAI and Anthropic. 400 billion in total. That's big money.
Yeah, it's a chunk of money, and
that brings you onto this chart. I like this chart.
Yeah, this is chart 6. I showed this previously, but I've updated it now with a projecting the net supply, assuming these IPOs go ahead, all this issuance comes to the market. The net issuance which is this red line. Wow. And I've projected it with the dotted line. That's the kind of net issuance figure that we're going to have this year.
It's an enormous increase.
Absolutely,
isn't it?
A massive supply of equity coming.
Is that visible? I can just see it on the right hand side, the dotted red line.
Yeah, that's right. And just to be clear, the blue bars are the IPOs and the offerings and that we've had to date on a quarterly basis. The green bars are the equity. It's the retirement of equity.
Stock
purchases and cash financed M&A.
Right.
So over the last 2.5 decades, like I said, on balance, equity has been taken out of the market. But now we're about to have a massive amount of supply, and an additional 400 billion coming to the market.
That's real money.
It is a lot of money.
Yeah.
So I think it's going to be a bumpy road from here to the end of the year. And I also don't believe that Treasury yields are going to, I've spoken many times about how 4.5% has been kind of a cap on the 10-year and 5% on the 30-year. I think at some point these yields are going to break higher. And I just want to show this final chart number 7. And this is average nominal GDP growth. 5-year average nominal GDP growth, and you can see
why is the Treasury yields lagging that?
Well, they don't have to stick to it, but
I'm asking you why it's lagging.
Yeah, I mean, over we had the great moderation from the 90s, and inflation declined, long-term rates declined, and then we had the great financial crisis and the recession that followed and the period of extremely slow growth afterwards. And you can see Treasury yields, the 10-year, did kind of track the trailing 5-year nominal GDP growth. But I would call it recency bias or whatever the term is.
Sorry, could you explain that, recency bias?
Well, it's a psychological term. Market participants get used to yields being at a certain level.
Oh, right.
Never going above a certain level. You hear expressions like, "Oh, if the 30-year gets to 5%, I'm going to fill my boots."
Yeah.
You know, that kind of thing.
Ignore the macro, just the number is the important bit.
Yeah, exactly. That's the level. And I think as a result of that, there is demand that slows it from busting through those levels. But I don't think inflation is going back down to the kind of levels that we had prior to the pandemic.
You've made that clear in the notes.
Absolutely, on several occasions. And GDP growth, it just doesn't seem to want to slow down. If you look at what we've just been through with the oil price,
it's not just made up of inflation, it's made up of growth and genuine growth as well.
A mix of growth and inflation. But real growth, the Atlanta Fed GDP now for Q2.
I saw that number.
Yeah, 3%, something like 3%.
Yeah, I saw that.
Comprised of mainly consumption. Consumption is growing at something like 2.7%.
Is that at the expense of savings still?
Not really. I mean, in Q2, I think the savings rate has been drawn down to cope with the higher
but when the houses are all going up, houses and stocks are still going up in price. What's the big deal?
Well, not only that, I think we'll see a better household income growth as a result of stronger job growth and stronger pay growth. The mix of those two, bringing in more cash into the economy. Consumers are happy to spend it. They're keeping their wallets open. And we've seen it with April and May retail sales, were way above estimates.
Okay, Jonny, look, I think everybody's got your message. Again, it's a similar message you've had before. Where can they read in more detail about what you think?
Yeah, so I write my daily notes. They can get a free subscription. Just go to super-macro.com, sign up, get a free 30-day trial. On the weekend, I do a more fuller roundup of the whole week's macro and, my analysis of the market and what I think is going to happen and the trades that I'm putting on. And you've got to understand that, the note for me is mainly a way of getting my thoughts in order, clarifying my thinking, and it has helped me trade. It's helped my trading a great deal. But the trades that I put in that note, I do rely on the outcome of those trades to make money.
Okay, so what you're telling us is what you do tell us, you do.
Absolutely, I do.
Thank you very much indeed, Jonny.
Thank you, Elvis.